company presentations now. And as a first company presenter, we have Tim Warman. He's the CEO of Fiore Gold. And I've interviewed for Fiore on SF Live before, and it was one of my favorite conversations, to be honest. And Tim runs a gold producer in Nevada. So I'm really excited to have him come on and give us an update on what is happening at the Pan mine. And I'm really excited to have Tim join us. Tim, are you with us?
I'm here. Good morning, Kai. How are you?
Good morning.
I appreciate you taking the time to listen this morning. I'm Tim Warman. I'm the CEO of Fiore Gold. As we say, they're a uniquely American gold company. And it's kind of an interesting story because all of our assets are in the United States. And at the moment, we are actually the largest 100% pure play domestic US gold producer, which is odd given that we are a sub 50,000 ounce producer at the moment. But I think we have a pretty solid plan to grow that profile. We're targeting a sort of near-term 150,000 ounce gold ounces per year production profile, and ideally we'd like to continue to grow that up into that sort of 250,000 ounce per year range, because it's really our thesis that there is a gap in investment opportunities, particularly for US fund managers. So if you're a US generalist and you're looking for exposure to the gold space, it's tough because almost every company you can invest in of any recent size is going to have some fairly difficult jurisdictions that they're operating in, and even the ones that operate a lot in the United States also operate in places like Papua New Guinea or in Central America or in Africa, and these are all challenging jurisdictions, whereas I think there's a real market for 100% domestic US gold producer that really appeals to that desire for exposure to gold, but with minimal political risk. So we have 3 assets in the United States, 2 in Nevada. The Pan mine, which is our producing asset, produces just under 50,000 ounces a year and generates some really strong cash flow that's being used to grow the company right now. Right next door, we have our Gold Rock project. It is literally next door. You can see one from the other. Gold Rock is permitted at the federal level, which means it's got a huge advantage in terms of time to production. We're currently doing a feasibility on that. And Gold Rock, once it's in production in a couple of years, and again, we're aiming at late 2023 to early 2024, that will more than double our production, take us up over 100,000 ounces a year. And then we're really looking to continue that growth, both in the near term and in the longer term, through M&A, through some strategic and well thought out acquisitions of other producing or near-term producing assets that we can bolt onto the company and create a real multi-asset US producer. I will say that we also have a third asset in the United States called Golden Eagle. This is a 2 million ounce M&I resource deposit up in Washington State. It's often overlooked in the company. We don't spend a lot of time talking about it. We're not doing a lot with it right now. But it's a really interesting large asset, and we think it has a good potential as a spin out or a joint venture, and I'll talk a little bit about why that is. But the interesting thing is this 2 million ounce deposit, this producing mine, and this permitted asset were all bought about 4 years ago for $5 million out of a bankruptcy transaction. I'll start with Pan. Pan is a typical open pit heap leach Nevada gold mine. You can see 2 pits, the North Pit and the South Pit. There's a major fault that runs through those that controls the mineralization. We mine from both mines. We put the ore on a leach pad down here. We leach the ore, produce gold doré in the ADR plant here, and sell that doré to the refiners. It's a very simple operation. It's an extremely well-run operation. We just press released this morning that we've just done 1 million hours worked without a lost time injury. In fact, we've never had a lost time injury at the site since we picked up the asset. And we have been the safest mine in Nevada for the last 5 years running. And that's a real achievement for any size operation, but particularly for a relatively small operation like this. And it really shows you how well that asset is run. We produced, as I said, last year, 46,000 ounces of gold in fiscal 2020. Just a note, our fiscal year ends at the end of September, so we're well into 2021 right now. You can saw there was an increase from the previous year. All-in sustaining costs, just under $11.50 per ounce last year. Look, we're never going to be the lowest cost quartile mine in the world. It's a relatively low-grade mine. It's between 0.4 and 0.5 grams per ton, but it's very efficiently run. And really, that lower left graph demonstrates that. $24 million US in operating cash flow from 46,000 ounces a year, and a lot of that cash adding to the balance sheet. And now this year we'll be spending that to continue to grow the company. You look at some of the earnings and the metrics per share. I think it just really speaks for itself at how well run the company is from a financial point of view. Going forward, Our production guidance between 44 and 47,000 ounces of gold production this current year. Our all-in sustaining costs will be a little bit higher this year, between 13 and 1350, and that's for a couple of reasons. One is we're going into a slightly higher stripping ratio phase in the mine life. That's the number of tons of waste we have to move for every ton of ore. That'll get up around 1.8 this year. Typically, it's about 1.6, 1.66 throughout the life of mine. The grade, as I mentioned, 0.12 to 0.14 ounces per ton. In metric, that's 0.4 to 0.5 roughly. And we'll be spending about 20 million in non-sustaining capital, partly on leach pad expansion. We just released a new resource and reserve update that showed we added another 2 years to the mine life. We've been very successful over adding to the mine life over the last few years. And now we have to build some leach pad capacity to take that ore. We'll also be spending about $10 million over the next year or so on our Gold Rock project, which is our next project, working towards the feasibility and doing quite a lot of drilling there. Just to wrap up on Pan, Pan right now, we've extended the mine life out to 2025. And every year that we've had this mine, we've been able to replace resources, replace reserves, continue to push out the mine life on this. You can see here on this graph, in 2017, when we first started mining, the resources and reserves are almost identical to the resources and reserves that we sit at today. And it's a big, big property. Here's the north pit, here's the south pit. All of these red targets along here are exploration targets that have never been drilled. They were defined by the previous operator based on gold in soils and arsenic and antimony anomalies in soils and alteration and structure, all of the things that led to the initial discovery of the Pan deposit. And we'll get out and start drilling these this year. In fact, we just drilled the first one of these called the Mustang target last year. We hit 8 holes, 5 of them hit very good, shallow, good grades, oxide mineralization, very similar to what we're drilling or what we're mining in Pan. And as we go into the drilling campaign this year, we'll put more holes into that and try to bring that into the reserve and resource estimate as well. We're pretty confident we can continue extending the life of mine. So with Pan operating really well, our focus turns to Gold Rock. This is our permitted growth asset. As I said, it's about 8 miles or 12 kilometers away from Pan. You can see there's a small open pit there left over from the 1980s. You can see the mineralization, that nice pinkish reddish material there, jasperoid is called in the United States and in Nevada. And that trend of mineralization, it's the crest of a fold in here. It runs for about 20 kilometers from one end of the property to the other. From above, in context, here's Pan up here. The red zones are the reserves and resources. The yellow zones are the exploration targets, and the same down here at Gold Rock. That trend that I mentioned, you can actually see it in the topography, and just carries on for tens of kilometers through that property. So lots of exploration upside there, and we're very confident in the exploration upside there. We're going to be doing about 30,000 meters or about 100,000 feet of drilling to expand the resource and reserve. At Gold Rock, we'll be doing about another 30,000 meters of drilling to step out and test some of these other targets, to do geotechnical drilling, to do metallurgical drilling, all in support of a feasibility study that will be completed towards the end of this year. Right now, Gold Rock has about 400,000 ounces of indicated, about 85,000 ounces of inferred. It's about 30% higher grade than Pan, but we're hoping to grow that as we go into the feasibility with all this drilling. And you can see on the left here some of the recent drill results here. 48 meters at 2 grams, 32 meters at 1.4 grams, 38 meters at 1.1 grams, all significantly higher than the average resource grade of about 0.66 at Gold Rock. So you can see how close the two deposits are. You can see Highway 50 up here. This is a site with excellent infrastructure. We have grid power. We don't have a camp. Everybody goes home at night to their homes in the nearby towns, which makes it actually quite a low-cost operation. Now, I mentioned we're working on a feasibility, but middle of last year, we released a preliminary economic assessment on Gold Rock, and that really envisaged Gold Rock as a satellite operation to our Pan mine. Sharing a lot of the infrastructure, sharing the same power line you see here in yellow, sharing the same access road that you see here. We'll have the same management team, the same operators, the same mining contractor, really, I think, minimizing the CapEx and the OpEx on that. In its PEA incarnation, 56,000 ounces a year for 6.5 years. We're hoping to grow both those numbers through additional drilling to grow the resource size. At $1,700 gold, some extremely attractive looking economics. And again, once this is in production in 2023, 2024, this will get us up over 100,000 ounces, really from the same mining complex in Nevada. I'll just briefly touch on our Golden Eagle property. This is this third asset in northeastern Washington State. It is just outside the town of Republic, Washington. It's an old historical mining district. They've been mining there since the 1800s. Kinross just put the last two mines in the area on care and maintenance in 2017, their Kettle River Mill and Buckhorn Mine. I know that Kinross is doing a lot of exploration around there with an idea of maybe reopening that. I know Hochschild is doing a lot of exploration in the area. They have a JV with another one of the juniors in the area. And also Hecla is doing quite a bit of work. And Hecla is actually our main focus right now on this, because even though the resource is entirely on our ground, it's a relatively small property, and we would need some sort of agreement with Hecla to put an open pit in here, because the edges of the pit need to go into that ground adjacent to us that's controlled by Hecla. And so we've been talking with them for the last couple of years. Ideally, we'd like to JV the project and spin it out with them, because they have, what they've told us is something in the 1.5 million to 2 million ounce range on their side of the property. In the meantime, it's costing us about $10,000 a year to hold on to this property. But one of the reasons I like this idea is that there's a lot of value unlocked here. If you look at what Golden Eagle is comparable to, if it were in a standalone company, it's very comparable to Integra Resources' DeLamar project in Idaho. Similar stage, similar size. Integra is getting a $250 million market cap for that. Golden Eagle is sitting as our third kind of unloved project and essentially getting zero value. So anyway, we're working on that. Capital structure, 98 million shares outstanding, 8.7 million options, RSUs, DSUs, no warrants, very clean capital structure, solid balance sheet, 19 million in cash, no debt. We haven't raised equity since 2017. We've been entirely self-funded. And if you look at the share price performance over the past 12 months or so, we've strongly outperformed the GDXJ and a lot of our peers. Excellent analyst coverage. And really, we think we're undervalued. And of course, I'm a junior mining CEO. I have to say that we're undervalued. But look, I think if you look at almost any metric, PNAV, price to cash flow, compared to a lot of our peers, especially peers that are operating in, again, some much more challenging environments, jurisdictions, I think we've had a good run up in the stock price. But I think as we continue to grow the company, as we transition from being a single asset, small producer, there's a real strong potential for re-rating there. I'll just kind of wrap up with this. We've tried to underpromise and overdeliver, and I think we've been successful on that so far. We took a bankrupt asset, we turned it around, we got it operating well, operating safely, generating cash flow. We put in a crusher, got our recoveries and our production up. We've continually extended the resources and the reserves now, keep pushing that mine life out, keep generating cash flow into the future. And of course, our next growth project, Gold Rock, is permitted. We got a PEA out on it. Now we're into the feasibility on that. And of course, the Golden Eagle resource update. And then finally, lots of upcoming catalysts throughout the year: exploration, development, and hopefully some M&A as well. I'll just leave it there. Nice picture of the Pan mine.
That's great, David. David, I just spoke to David. Tim, fantastic. I really appreciate running through the presentation. I actually have a couple follow-up questions for you. Sure. And you're producing quite a bit of free cash flow, obviously, from Pan. Run us through how you're going to spend that, because you are exploring at Gold Rock, and how much are you spending on exploration, for example?
Yeah, so we don't break it down specifically on exploration, but certainly at Pan we typically spend $1.5 million to $2 million a year just on kind of drilling out near the deposit, adding to the resources and reserves, kind of growing that resource and reserve base. We'll be spending probably a good part of $10 million over at Gold Rock, drilling out that asset, growing it, infilling it, testing some new targets over there. So it's a pretty aggressive exploration program. And in fact, I say when we're doing M&A, we're looking for other producing assets to grow the production side. But we might even look at an earlier stage project if it's the right price and it looks promising, to add to that exploration potential. So we're pretty open in that regard.
Fantastic. What kind of gold price, when you do your internal forecasting, what kind of gold price do you tend to use? Like, is it consensus, or like run us through that process? I think that'd be helpful.
Yeah, I mean, I think when we did our last resource update, we used around 1550 or 1575, which I think is a reasonable one to use now. Previously, we'd been using around 1300, but at 1300, you're starting to do mine plans, for a gold price that we haven't seen in a couple of years, and it's not very efficient. So, and because we're a small mine, we can adapt to changing gold price conditions, fairly quickly. But yeah, so in that 1500 to 1550 range is really where I think it's kind of a good place to be right now in forecasting.
Yeah, I think it feels pretty good. At 1850, gold had a bit of a false breakout, it looks like, this morning. So I feel pretty confident with 1800 even, because you're producing free cash flow. Like, what else what else do you need, right? And
Yeah.
making money. Exactly. Fantastic. Tim, thanks so much for joining us.
Thanks, Guy.